The daily routine of global commerce often masks the fragile nature of international supply chains. A single political decision can instantly disrupt the flow of essential resources worldwide. The world recently witnessed this harsh reality when diplomatic efforts collapsed and forced a major closure of a critical maritime trade route. President Donald Trump ordered the United States Navy to blockade the Strait of Hormuz, following the failure of peace negotiations in Pakistan. The discussions lasted for 21 hours, but ended without any agreement between the delegations representing the United States and the Islamic Republic of Iran. The immediate market reaction was swift and severe across all trading platforms. The price of Brent crude oil jumped 8% and surpassed $100 per barrel. This sudden surge reflected massive panic among energy traders regarding the potential loss of vital petroleum shipments from the region. Vice President James David Vance led the United States delegation during these critical meetings in Islamabad. The American negotiators demanded that Iran permanently dismantle its highly enriched uranium facilities. Iranian officials refused to provide an affirmative commitment to abandon their nuclear enrichment activities during the negotiations. The Iranian government maintained several strict demands that complicated the diplomatic process. Tehran insisted on retaining control over the Strait of Hormuz and collecting transit tolls. They also demanded the immediate release of $27 billion in frozen oil revenues held in foreign bank accounts worldwide. Following the diplomatic collapse, President Donald Trump declared that the United States Navy would enforce a strict blockade. The military directive ordered American forces to intercept any commercial vessel attempting to pay transit tolls to the Iranian government for passage through the strategically vital maritime corridor. The Strait of Hormuz serves as an indispensable artery for global commerce and energy security. Approximately 20% of the daily global petroleum supply travels through this narrow passage. The disruption has therefore created massive physical shortages of crude oil for refineries located across Europe and Asia. United States Central Command stated that the blockade would be enforced impartially against vessels of all nations entering or departing Iranian ports. This extraordinary military measure represents a significant escalation in American naval doctrine and directly targets the primary economic lifelines sustaining the current Iranian state apparatus. The Islamic Revolutionary Guard Corps Navy issued severe warnings against any foreign military interference. Iranian naval commanders declared that any warships approaching the area to enforce the American blockade would be dealt with decisively and harshly. They maintain that the strategic waterway remains under their full sovereign control. Global shipping companies have responded by completely altering their traditional navigational routes. Major operators like Maersk and Mediterranean Shipping Company have suspended all transits through the region. They are now rerouting their enormous commercial vessels around the Cape of Good Hope to avoid the dangerous conflict zone entirely. This massive logistical detour adds 10 to 14 days of transit time for shipments traveling between Asian manufacturing hubs and European consumer markets. The extended voyages require significantly more fuel and tie up enormous amounts of capital, while severely disrupting modern manufacturing practices that rely on punctual component deliveries. Freight rates on corridors linking Asia to the United States have already spiked by 30 to 50% due to these unprecedented challenges. Maritime insurance markets have practically collapsed as underwriters refuse to cover vessels operating near the Persian Gulf without charging astronomical premiums for war risk coverage. The conflict has paralyzed 20% of the global liquefied natural gas trade. Qatar Energy was forced to declare force majeure on exports because specialized tanker vessels could not safely depart from their loading terminals. This development creates severe energy insecurity for numerous importing nations across the globe. Asian economies are particularly exposed to this specific maritime disruption. Japan and India depend on the Strait of Hormuz for approximately half of their crude oil imports. Their national currencies have weakened significantly against the dollar, as governments scramble to locate and secure alternative energy supplies at premium prices. Macroeconomic stability in the United States faces severe threats from this geopolitical crisis. The Consumer Price Index showed inflation soaring to the highest reading in nearly 2 years. The Energy Index rose dramatically, primarily driven by an extraordinary spike in retail gasoline prices across all American states and territories. The Federal Reserve is currently navigating an incredibly complicated situation regarding monetary policy. Central bankers must weigh the severe risk of a sustained inflationary shock against the potential for an economic slowdown. The resurgence of headline inflation has forced policymakers to postpone any planned interest rate cuts for now. European nations are equally troubled by the cascading effects of the maritime blockade. The European Central Bank has explicitly warned that a prolonged closure will likely trigger a period of stagflation. Growth projections have been slashed as the continent grapples with the sudden disappearance of reliable natural gas shipments. Low-income economies around the world face a direct threat to their food security. The sudden spike in fuel and fertilizer prices creates immense financial pressure for agricultural sectors globally. Experts warn that this situation could rapidly deteriorate into widespread humanitarian crises if supply chains are not restored quickly. The regional impact is exceptionally severe for the Gulf Cooperation Council member states. Nations such as Kuwait and Bahrain depend heavily on seaborne imports to meet over 80% of their daily caloric intake requirements. The maritime blockade has consequently triggered a profound grocery supply emergency throughout the peninsula. Local retailers in these affected Arab states have been forced to charter expensive cargo aircraft to airlift basic food staples. This desperate logistical adjustment has resulted in dramatic increases in consumer food prices. The systemic failure of the free export model has become an unavoidable daily reality locally. The conflict over the strait has generated a profound legal debate regarding international maritime rights. The United Nations Convention on the Law of the Sea clearly recognizes the area as an international strait. Under this convention, vessels are guaranteed the right of continuous and unimpeded transit passage during peacetime operations. Iran argues that since it never formally ratified the convention, it remains exempt from these specific transit provisions. The Iranian government asserts the authority to exercise smart management over its territorial waters, especially during wartime. They claim the right to control navigation and demand fees from foreign ships. The United States has historically recognized the provisions of the convention as customary international law. The American military routinely conducts freedom of navigation operations to aggressively challenge excessive maritime claims worldwide. However, the current policy of physically interdicting vessels that pay Iranian tolls presents new complex legal questions. Legal scholars point out that an opposed boarding of a neutral merchant ship is traditionally considered a severe violation. Actions against vessels flagged in nations like China or India could be interpreted as direct acts of war. This adds another volatile layer to an already explosive international standoff. The diplomatic stalemate at the United Nations Security Council prevents any coordinated global response to the crisis. A resolution proposed by Bahrain and other Gulf nations sought authorization to use all necessary means to reopen the waterway. However, this decisive action was promptly vetoed by China and Russia. The Chinese ambassador argued that the proposed resolution entirely failed to address the root causes of the regional conflict. The Russian representative pointed to the military attacks initiated by the United States and Israel as the primary source of instability. This veto effectively eliminated any immediate international mandate. Despite the ongoing military escalation and naval blockade, diplomatic backchannels remain surprisingly active. Pakistan has emerged as a proactive mediator, hosting multiple rounds of shuttle diplomacy between the warring factions. Pakistani officials are facilitating crucial indirect communication between Washington and Tehran to prevent total war from breaking out globally. The Iranian president has openly praised the Pakistani mediation efforts despite his military preparing for renewed defensive strikes. Pakistan possesses vital economic and security interests that are heavily dependent on maintaining regional stability. As a goodwill gesture, Iran even granted safe passage to several Pakistani-flagged commercial vessels. Oman shares the southern coastline of the strait and has called for painful concessions from all involved parties to restore peace. The risk of regional spillover remains exceptionally high for these neutral mediators. A recent drone strike on an Omani port clearly underscores the danger of the expanding conflict. The European Union proposed an initiative seeking to establish a diplomatic coalition with India and China. They are pushing for a comprehensive peace summit to be held in a neutral venue like Riyadh or Istanbul. European leaders desperately want to avoid a scenario where global energy markets collapse completely. The conflict has also significantly impacted Lebanon, where Israeli military forces have continued strikes against Hezbollah targets despite the temporary ceasefire. Iran previously proposed a peace plan that explicitly linked the opening of the strait to a complete cessation of Israeli military operations inside Lebanese territory and airspace. This strategic intertwining of the Persian Gulf and the Levant theaters complicates matters greatly. It suggests that any permanent resolution regarding the Strait of Hormuz must be incorporated into a much broader regional security arrangement. Isolated agreements appear doomed to fail given the deeply interconnected nature of these conflicts. By utilizing a strict naval blockade to counter Iranian management of the strait, the United States introduced a dangerous new paradigm. This approach to economic warfare directly challenges the foundational principles of international maritime law. The strategy risks normalizing blockades as standard diplomatic tools in future geopolitical disputes. The immediate return of triple-digit oil prices demonstrates the extreme vulnerability of our modern energy-dependent economy. Global inflation surged simply because a single 38-kilometer-wide chokepoint was effectively closed to commercial traffic. Analysts worry that similar geographic vulnerabilities exist elsewhere in the global supply network. For the shipping industry, this crisis has exposed the harsh limitations of standard insurance and logistics models. The shift toward the Cape of Good Hope routing provides a tactical bypass, but imposes immense structural costs. These increased transportation expenses will likely lead to permanently higher consumer inflation. The failure of the United Nations Security Council to act effectively highlights a deepening fracture in the entire international order. Major global powers no longer agree on the fundamental rules of maritime navigation and sovereign rights. This institutional paralysis guarantees that regional conflicts will remain difficult to resolve through diplomacy. Without a massive breakthrough in negotiations regarding nuclear weapons programs, the world faces a prolonged period of energy insecurity. This geopolitical risk could permanently reshape the global economic landscape for decades to come. Countries heavily reliant on imported energy resources are already planning desperate measures to survive the shortage. Refiners in Asia and Europe are frantically paying record premiums for prompt delivery of physical crude oil. The market realized that the failed ceasefire effectively removed up to 2 million barrels per day of Iranian-linked oil flows. This sudden supply shock triggered a panicked race for available barrels worldwide. Some analysts suggest the crisis has surpassed the magnitude of previous historical energy shocks seen during the 20th century. Unlike those past events where supply disruptions were limited to small market percentages, the current closure affects 20% of daily global supplies. The sheer scale of this disruption is completely unprecedented. Saudi Arabia successfully restored its major pipeline capacity to 7 million barrels per day. However, this overland bypass remains completely insufficient to cover the total loss of traditional maritime transit. The strait typically accommodated over 100 massive oil ships daily before the hostilities effectively shut down the corridor completely. The American military aims to establish a protected passage to encourage commerce separate from Iranian-controlled corridors. Central Command announced that the Navy is actively setting conditions for complicated mine clearance operations. Iran reportedly threatened to completely mine the Persian Gulf if its infrastructure is attacked. British Royal Navy frigates have assumed an advisory role to help ensure the safety of commercial shipping, without declaring a formal blockade. French Navy frigates are also providing defensive escort missions to protect vital European commercial interests. Meanwhile, the Indian Navy dispatched destroyers to safeguard their national flagged vessels. The conflict paralyzed aviation networks across the Middle East as regional authorities enacted multinational airspace closures. Emirates and Qatar Airways faced a near-total cessation of their flight operations. Thousands of passengers were stranded globally, sparking repatriation efforts described as the biggest since the recent global health pandemic. The war more than doubled the price of aviation fuel because refineries lacked certain types of specialized crude oil. Airlines increased ticket prices drastically or simply canceled flights to maintain positive cash flow. Rerouting planes around the active war zones added substantial journey times and enormous fuel costs for operators. Stock markets globally experienced severe declines, while investors executed a massive global bonds market sell-off. The Dow Jones Industrial Average fell over 400 points, reflecting mounting fears regarding sustained inflation and broken supply chains. Conversely, gold prices rose sharply as investors frantically sought a traditional safe haven asset. Developing economies faced immense currency pressures as central banks grappled with difficult interest rate decisions. The value of the American dollar rose significantly against emerging market currencies during the initial days of the conflict. South Korea saw its market index suffer its biggest crash since the previous financial crisis. Global commodity markets suffered immensely due to the near-total halt of tanker traffic. The region accounts for roughly 45% of the globally traded sulfur commodity. This sudden supply stoppage spiked fertilizer production costs, which deeply impacts global agricultural yields and threatens long-term international food supply security. Helium supply chains also experience severe disruptions because the gas is extracted alongside natural gas production. Qatar represents one of the largest global helium producers and refiners. Helium prices doubled and sometimes tripled because it remains an absolutely essential component for manufacturing advanced semiconductors and operating sophisticated medical imaging equipment. The conflict directly impacted the international aluminum market as well. The Gulf states produce approximately 9% of the total world aluminum supply. The immediate price increase cascaded through major consuming industries, including automotive manufacturing, aerospace engineering, and commercial construction sectors that rely heavily on consistent imports of this vital metal. The Iranian economy suffered devastating blows to its critical infrastructure and revenue streams. Analysts project that the national economy will shrink by 10% due to the ongoing war. Severe food inflation surged drastically, with the price of basic cereals and red meat doubling within a few short weeks. The Central Bank of Iran issued an unprecedented 10 million rial note to combat hyperinflation. Transportation costs climbed sharply, affecting rural populations, who experienced inflation nearly 20% higher than urban residents. Heavy bombardments obliterated military investments and severely damaged essential civilian infrastructure, including several major steelmaking facilities. The conflict threatens to trigger an exodus of expatriate talent and tourists from the Gulf region. Professional workers from India have been repatriated in large numbers, altering local demographics. Dubai tourism suffered immensely as hotel bookings plummeted, and major international sporting events were abruptly canceled or rescheduled entirely. Caucasus nations remain diplomatically cautious due to severe trade and national security concerns. Armenia and Azerbaijan fear the proxy conflict could merge with their territorial disputes. Azerbaijan deployed troops toward the Iranian border, citing risks of dangerous skirmishes if internal Iranian security collapses during the ongoing war. Turkey fortified its military presence along the Iranian border to safeguard its airspace from potential spillover effects. Tensions reached terrifying levels as the conflict expanded into the Mediterranean. European countries fear the Suez Canal trade route could be destroyed if hostilities reach the Gulf of Aden eventually. The conflict presents critical security challenges for countries like Italy that rely heavily on Mediterranean trade corridors. Central Asian nations struggle since the closed strait cuts off their southern trade access. Landlocked economies face immediate inflation risks due to skyrocketing insurance and freight transport costs globally. Pakistan implemented emergency austerity measures to conserve fuel amid soaring petroleum prices. The government mandated a 4-day work week for public offices and closed educational institutions temporarily. Bangladesh declared a state of emergency after panic buying and severe fuel shortages crippled their domestic transportation infrastructure entirely. In Europe, the conflict coincided with historically low natural gas storage levels following a harsh winter. The European Central Bank postponed planned interest rate reductions and raised its inflation forecast, warning of a potential technical recession. Industrial output declined as manufacturers imposed surcharges to offset surging electricity costs. African nations also experienced the ripple effects of the crisis despite their distance from the battlefield. Egypt suffered massive economic losses due to declining traffic through the Suez Canal. The Egyptian government warned that the prolonged conflict severely threatens the economic national security of the entire Arab world. Ethiopia projects severe price shocks because its economy relies almost entirely on imported refined petroleum products. Skyrocketing maritime insurance premiums instantly translated into inflated import prices for their vulnerable economy. Some experts suggested transitioning rapidly toward electric mobility to reduce demand for expensive imported oil and mitigate the crisis. The United States defense industry reported near-total disruption of critical minerals normally shipped through the strait. Trump threatened to obliterate Iranian power plants if they refused to reopen the waterway immediately. He later extended the deadline, claiming productive conversations occurred, but Iranian officials firmly denied holding any negotiations.